Hello, I hope you're doing well. I feel like I've written this too many times as markets have developed, so this is written as of information on March 10th, 2026. As I write to you, Pittsburgh is heating up with near all-time record temperatures as we've thawed after the negative temperatures of early midwinter. If you look at our rivers a few weeks ago, you would have seen sheets of ice lingering on the surface. What a few weeks prior you could likely confidently walked on have become shaky at best. Regardless, though, underneath the current never stopped. Investing works much the same way. There are seasons when the surface appears frozen, headlines feel heavy, data looks sluggish, and it can seem as if progress has stalled in a Groundhog Day-like fashion. But just like a river, the underlying current of the market and your portfolios continue to move. Companies adapt, consumers spend, innovation flows, and opportunities are carried forward as markets constantly reprice risk and reward. Per our 3-meeting conversation system, I'll be setting up conversations at your convenience in the coming months and look forward to seeing you. Thank you again for your continued trust and support. I hope you find this month's letter informative. In this letter, we'll take a look at Mount Washington to the Cultural District, and in this case, the short version is going down Greenleaf right at the West End Bridge or Shaler Street during non-rush hours and loop back through the Fort Pitt Tunnel, then proceed through Fort Duquesne Boulevard. Tax documents are in the process of being mailed from LPL Financial, and many have already been sent or delivered. Please let me know via phone or email if you have not received documents by now. These are also available electronically in your Account View 2.0 portal. You can also find prior year's tax documents there. After logging in from the TRDC website, click Documents, followed by Tax Forms. These will appear as soon as they are available on an account-by-account basis, so if you see one account and not others, know that this is normal. SpaceX and OpenAI holdings have been added via a closed-end fund. It has Destiny in its name and was mentioned in a previous email. This is likely a hold through the potential SpaceX IPO and has room to be added to given market valuations. Wilbur and Marigold were trimmed twice in most accounts back down to 5% prior to their respective drops early in the year. We continue to hold producers which were down approximately 1/2 of the underlying materials. I believe the large moves were due to excess leverage and not necessarily fundamentals in the underlying materials on both the upside and now downside. Again, these serve as hedges against the debasement of the mediums of exchange you use on a daily basis, and I am confident in their purpose in your portfolios. They have since largely recovered within less than 11% of all-time highs. Our 3 international overweights since adding have been mixed overall. Indonesia and the Philippines are down single to low double digits and may be added to. Thailand is up solid double digits in contrast. These are long-term investments, and I believe market reforms in Indonesia especially will be more fruitful in the coming years. They are not anchor positions and represent a maximum of 7.5% of your account at time of purchase. We'll continue to monitor and evaluate their perceived long-term value, but for now, these are multi-year holdings. Your account may be different due to tax loss harvesting. In general, and largely as expected, I see the market broadening. At this time, the big surprise is in Wilbur and Marigold. Software and digitally related services are becoming more attractive, and I'm evaluating their merit to portfolios on an individual company basis for larger accounts and through an ETF or ETFs in smaller accounts. Valuations based on metrics of free cash flow and others are catching my interest. Private credit also has my attention on the fixed income side as the space hits multi-year lows. Hard assets versus Wilbur or Marigold are also an interesting laggard, which I will discuss at our next conversation. The thick black stuff that comes out of the ground is interesting as well, after going above $119 to now $86. Some thoughts on AI disruption going forward. This is much bigger on a societal level than what most think, in my opinion. Being benchmark agnostic, it is my goal to recognize, safeguard, and capitalize to the best of my ability these coming changes. As with any large disruptions, there are winners and losers with exaggerated moves in either direction. Some of these are warranted and others are not. Next, we'll take the long way, again from Mount Washington to the Cultural District. So let's take PJ McCardle, hope we randomly time the light onto the bridge, and then work through the cross lights downtown. As always, contact me directly with any questions with respect to taxes. I'm happy to coordinate with your tax accountant and welcome it. Everything is confidential, and I won't ask for personal information without your explicit authorization. I can send documents through your accountant's secure portal or through a secure email on TRDC's end. With respect to SpaceX and OpenAI positioning, again, we've made an initial allocation to a closed-end fund that has substantial holdings in SpaceX and OpenAI. SpaceX recently purchased xAI, and I anticipate Tesla could potentially purchase SpaceX or some combination of a merger with all three under one umbrella. My preference would be for these to instead stay separate, but it's not my call. I've left additional space for increased investment from a risk-reward perspective within the closed-end fund I've already allocated to on your behalf. With respect to Wilbur and Marigold again, there was a substantial drop after a crack-up boom in values of Wilbur and Marigold when I last wrote. This was expected, but not to the magnitude we saw. We do not own the underlying outright and instead have and continue to own their producers. From experience, I've found the producers to be a more logical investment for two primary reasons. One is that futures markets, by their nature, can have roll costs and profits that I do not want to be exposed to. The other is that I believe the producers in aggregate provide a smoother investment experience as you work towards your financial goals. We saw the effects of the latter, where on the downside producers have gone lower, but not nearly as much as the underlying materials. I trimmed these positions in most accounts twice this year already, moving back down towards 5% positions, and ended up adding to positions in the downtrend to again move back up towards 5% in the more aggressive accounts. Your account may vary depending on tax situation and risk tolerance. Having traded them for years, it is my summation that the move was non-fundamental in nature on both the upside, the less so, and downside. Other elements came into play at the end of January, which I believe was the result of over-levered holders at month end and a change in margin requirements. I continue to have conviction in the space over the long run. These producers lock in higher prices on a regular basis and so can be less affected by day-to-day fluctuations versus the underlying. I expect profits for these companies going forward to be more than justify the current prices and valuations, despite being back towards all-time highs. In general, software companies have become a focus of pressure, with the idea being software will become essentially free due to AI offerings. I think this is largely overdone, but in some areas may be true. In my opinion, businesses, and TRDC included, are not going to outsource to free cybersecurity, legal, or electronic signature platforms, for example, at this time. There's simply too much compliance risk. I am seeing many companies now trading in price to free cash flow multiples of well under 10 times, which from a business owner's perspective warrants more investigation. These low historical valuations create what I'm looking for: profitable companies with attractive asymmetric risk-reward on their own, with room to participate in multiple expansion. As always, my goal in your account, and by extension my own holding the same assets, is to benefit from multiple expansion and to mitigate exposure to contraction in contrast. Private credit is seeing lows near the tariff tantrum from this past April and yielding over 12%. I'm eyeing this as a potential diversifier in fixed income. I have yet to decide if this should be pulled from core fixed income holdings or our satellite positions in international. The thick black stuff that comes out of the ground is interesting, and I'm looking at how to best express my investment thesis. Lots of levered investors have contributed to the underlying swings of late. Briefly on Iran, it contributes less than 0.5% of world GDP. From an economic investment perspective, this will be a non-issue. Oil production as a percentage of the world output is much higher and may increase prices of goods and services in the short term, but most issues will be second and third order in magnitudes not insurmountable. A reminder that the U.S. remains much more energy independent than in the prior decade. Thank you again for your continued trust and support. It's my privilege to serve you, your family, and your businesses. Take care. Bye.